Thanks to Sharesies for organising this event, and thank you to everybody for coming along at the end of what's often a long day for people, so well done, good on you. I just wanted to underline that if you've got a question or a comment about what I'm saying at the time, please just raise your hand. Don't hold it till the end, because there might be a particular slide you want to ask a question about or disagree with me about. If I don't see you, just yell out, okay? Now, this was in the Herald a few days ago, last week, November the 21st. Liam Dan was writing about the possibility of the markets going down, and certainly there's been a lot of people talking along those lines lately, and this graph really tells you why. So we're going from 1973 through to the present. The red line is international shares and the green line is New Zealand shares, and you can see the huge big boom in the 80s. A few of you might be old enough to remember that. I certainly do. The 87 share market crash there on the green line. And then we're coming through and we've got the tech boom and the international shares, but not New Zealand shares. There weren't any really big tech shares in New Zealand at the time, so we didn't go through that wonderful boom, got left horribly behind, and then there was this terrible bust, and we were very glad we were out of it. And then along here we've got the global financial crisis. But as you can see, in the last 10 years or so since the global financial crisis, the markets have just kept on going up, basically. A few blips here and there, but a lot of people are looking at those numbers, and particularly the New Zealand rise, it's extraordinary, and saying we're headed for a fall. Now, all I can say about that is the markets will go down at some point in the future, and they might go down fast, they might go down slowly. It will happen at some stage, and we don't know when. And so what I want to talk to you today about is how to sort of protect yourself from doing badly if the markets turn against you. So the bulk of the book is 8 chapters, about 8 different steps to getting your finances sorted. And the first step is just to get started. Obviously, you're never going to get anywhere if you muck around on the sidelines and wondering what to do. Second step is to kill off high interest debt. If there's anyone in this room who's got credit card debt that you're not paying off on a regular basis when the payments are due, please get rid of it. Don't even put any more money into Sharesies until you get rid of it. It's a terrible thing, high interest credit card debt. It really kills. If you get in the habit of building that up, you're going to retire with a lot less money. Third chapter is about insurance and rainy day money. That's all pretty obvious, the importance of that. Then fourth is getting the best out of KiwiSaver. Those of you who read my column know I write a lot about that, and there's a lot about it here. Boosting your saving painlessly, staying cool when the markets go bad, and that's what we're going to come back to in a minute. Heading confidently towards retirement. It doesn't look like many of you are at that stage of your lives yet, but some of you might be, and some of you might be retiring young if you do really well with your Sharesies, of course. I get letters from people who are retiring at 50 and sometimes even younger. So buying a house, I didn't know when I made this list up, it was meant to be sequential. That's what you should do first, that's what you should do second, etc. And I plugged buying a house in here and I plugged buying a house in there, and it all... Some people will buy the book and they already own a house. Some of you maybe will never own a house, and that's all right too, as long as you get to retirement with a good chunk of savings to cover your accommodation through retirement. You don't have to own a house. It's not essential in New Zealand. And finally, in the book, I ponder how much money we really need to be happy and look at a lot of research on that, and that's why the book's called Rich Enough. But enough about the book. We're going to zero in on chapter 6, or step 6, which is about staying cool when the markets go bad. I've got 5 rules here for how to protect yourselves from market downturns. The first one is about spreading your risk, otherwise known as diversification. The second is largely ignoring past performance. Thirdly, don't try and time the markets, please don't. Fourthly, never be forced to sell. And fifth, the nicest one of all, is sit back and relax. These rules came out of, I did my MBA in the University of Chicago back in the 1980s, learnt this stuff then, and it's never changed. We've been through all sorts of market rises and falls since then. It's basic stuff that won't change. It's really solid stuff that I hope I'll convince you of, because some of you probably trading quite often, or planning to move out of the markets before they go down, or other clever things like that that just in fact don't work. So the first rule is about diversification, getting your eggs in a lot of different baskets. And there are 3 different aspects to diversification, and we'll look at those in a minute. First, we've got a quote from Vanguard founder John Bogle. Vanguard John was talking about BlackRock. Vanguard is the other huge, big index fund manager in America. I think Sharesies is. Do you do some work with Vanguard? Do you know? Some of your through Smart Shares. Yes, Smart Shares in turn invests in Vanguard funds. Huge, big American company. And Bogle said, "Don't look for the needle in the haystack. Just buy the haystack. Buy the whole lot." So the first type of diversification we're talking about here is owning many different shares, or bonds, or properties, or in this case, spices in the spice market. So rather than investing your money in one share or 2 shares, and through Sharesies you can spread your money over a lot of different shares, of course. It's not a good idea. Too many New Zealanders do that. I saw some data, it's quite old now, but the average number of shareholdings that people who invest directly in shares have got in New Zealand is 1.5 or something like that. So a lot of New Zealanders own shares in just 1 or 2 companies. Not a good idea. You really want to spread your risk for the obvious reason that single shares can go bad, and you can come a terrible cropper if you own just a few different types of investors. The same with bonds, the same with properties. Put a question mark after that. I'll get to you in just 1 sec. Just finish my sentence. With properties, we're talking about. I'm talking about rental properties here. And it's quite hard to own quite a whole lot of different properties. I mean, there are certainly people out there that do it, but they're big, bulky purchases, aren't they? So that makes it hard. And I'll get to the question just a sec. The best way to spread your money over a whole lot of different investments is obviously through a share fund of some sort, which is the sort of investment you're getting through Sharesies. By far the easiest way and the best way for most New Zealanders. You don't want to be concentrating on a single industry. There's a lot of research to suggest that's not a smart idea. So yes, it's a good idea to be across a whole lot of different industries as well. Yeah. And moving on to the second type of diversification. So not only just owning a lot of different shares or a lot of different bonds, it's a good idea to own some shares, some bonds, some property. Many of you, the property side of it will come from owning your own home, and that's generally, for most New Zealanders, that's enough property. Although, some people do very well with rental properties as well. It's a good idea, though, to have some shares and some bonds. The shares for your longer term money, the money that you're not planning to spend for a long period, 10 years or more ideally. If it's money that you're planning to take out and do something with within 8 to 10 years, it's a good idea to have it in a lower risk investment. It could be in a balanced fund, which has got some shares, some bonds, some cash type investments in it, or it could be just in bonds. So you want to match your investments to the time period you've got. So you want to have not just a whole lot of different nectarines and a whole lot of different, what are they? They look like Tamarillo something, I'm not sure. A whole lot of different bananas. You want to have some of the different fruit is the idea as well. What about gold? Good old gold. Anyone here investing in gold? I think it's a one hand, yes, yeah. There's nothing, it's not a bad investment, but people can be dazzled by it. In 2009, 2010, coming out of the global financial crisis, and quite often this is what happens, when the markets have been plunging, people panic and rush into gold and look what was happening to the price. But then it's not been so good after that. What's the big negative about gold compared with investing in shares and property and bonds? Can you think of why I would say storage is a good point but it's not what I was after. Yeah, because you can invest just in shares and gold mining companies and that sort of thing, so you wouldn't actually have to store. When you invest in shares, you get 2 types of returns. You get the gain in the price if you sell at a gain, and you get the dividends. And when you invest in bonds, you get interest, and you might also get a gain in the price in bonds. When you invest in property, you get rent, and also hopefully a gain in the price. When you invest in gold, there's only the gain in the price. If you don't get that gain, you've got nothing going through. So nothing wrong in itself with owning a little bit of gold and investing in it, but I would suggest you don't put much into it, and certainly don't get caught up if the markets go down, or rather when the markets go down, this sort of thing will start happening again. Don't jump on the bandwagon and put a lot of money into it. Chances of your account balance falling. So this would be investing in a 100% share fund versus a balanced sort of fund that's half shares, half bonds. And you can see over a single year, there's a bigger chance that this is the chance of your account balance actually falling. So from January the 1st to December the 31st, got less in the account at the end of the single year. There's 1 in 3 chance in a share fund that that's going to happen. 1 in 4 in a balanced fund. But as you come on through, in 10 years, it's actually very unlikely you'll lose money in a share fund. Typically, you gain quite a lot of money. And this is called kind of never. You're not going to lose money if you've got 10 years in a balanced fund. But you can see looking through there the way this is lower risk, mixing the 2 different types of assets certainly cuts down your volatility. And this is another way of looking at it. We've got our same New Zealand share prices coming through here and the international ones, but we've also got commercial property coming through with the sort of mustard coloured line, and bonds coming through with the blue. You can see how sometimes one's going up and another one's going down, and you tend to get a smoother ride if you've spread your investments across a whole lot of different types of assets. So looking again at the same just New Zealand and overseas shares, the third type of diversification is to go offshore. You want to get out of just New Zealand investing. When you look at the graph as it runs at the moment, actually, you might be saying, oh, why would I want to? Look how much better New Zealand shares have done in recent times than international. If you were having a look back in here, in the late 90s, you'll be seeing world shares doing way better than New Zealand, and that'll happen again. They come and they go. When you look at these graphs over long, long periods, sometimes one's doing better, sometimes the other's doing better. Really good idea to go offshore. John's Pathfinder investments funds are all but one, you said, I think, are international, aren't they? Yes, yeah, and it's a really good idea to have some of your money out of New Zealand. It lowers your risk a lot. Think of the risks in this economy of a major natural disaster like Rangitoto erupting, or huge, Wellington getting wiped out by a quake, or a agricultural disaster, foot and mouth disease, that kind of thing. Our economy is vulnerable to one-off shocks that could really push down the value of the investments in New Zealand, certainly for a fairly long period. You're far better off to have some of your money in international investing. So moving on to rule 2, largely ignore past performance. Now, why do I say largely? The next few slides I'm going to hopefully convince you to pretty much ignore past performance, but there's two reasons why I don't fully say that. One is that if you were trying to decide which share or which share fund or something like that to invest in, and one of them had performed really badly year after year for the last 10 or 15 years, well, you might want to avoid that one, because that would suggest perhaps that there's bad management going on in the fund or whatever. Also, you can certainly learn from past performance when we flick back to something like this, when we're looking at this and I'm saying, look at the rocky performance of the shares over the long period, but look how much more money you've got at the end compared with, say, bonds, which have a much, much smoother ride, but you end up with a lot less. There's always going to be that trade-off over long periods. The more volatile ones are going to end up with more money, even though you have a rockier ride going through. So you can learn from that kind of past performance, looking at the big, big picture. But what I'm talking about is particular funds, particular type of assets over short periods, etc. So John Templeton, who's a British fund manager, says the 4 most dangerous words in investing are "this time it's different." You hear that I've been around long enough to hear that quite a few different times, when different times when the markets were booming. In the 80s, when the New Zealand market was soaring up, people were saying, oh, we finally learned how to invest properly in New Zealand and it's all going to be fine and everything's going great guns and we've got a new Labour government that's doing revolutionary things, but we're not, it's not going to crash, and it did. And the same with the tech boom in the late 90s, when around the world all the high-tech shares were going up and up and up, and there were so many people saying then it's a whole different economy now. There won't be a crash, and there was a crash. Don't ever listen to people saying this time it's different. Looking here at different types of assets across the top here, so we've got cash and bonds and property and shares, and these are over quite a few years down here. Note first the different range of returns, and so in cash we've got, it always makes under 10%, no negatives, but very low volatility there. And as you come through these, the bonds, there's some high, the highs are bigger and the lows are lower than in cash, but then coming through to commercial property in New Zealand shares, for example, commercial property, we've got highs of 25, 24, but lows of minus 21. And similarly for New Zealand and international shares, you get a much, much wider range of returns on these riskier investments here. And note too that 7% is the worst anybody did in 2005, but in 2010, that was the best one, was 7%. So there's huge variations in investing. But the main point I want to make from this table is the way a particular type of investment can change from being best to worst over 1 or 2 years, or worst to best. So we've got bonds going from worst, 2 years later they're the best return that year, next year they're the worst return that year, next year they're the best again. We've got commercial property going from best to worst, we've got New Zealand shares going from worst to best. This time that one took 2 years, but you've got runs as well, and I'm not denying that. There's a run down here of Kiwi shares doing particularly well year after year, but quite often the ones that have done really well one year do really badly the next year. And it's understandable when you think about it. What happens is a particular type of investment becomes flavour of the month and everybody gets into it. And it gets bubbly, it gets overbid up. Everyone's buying and suddenly people say, God, this isn't so good. And things go down, and then quite often they go down too far. Everyone starts panicking and getting out, and the prices go down too far. So next year there's a big chance for them to go back up again. And that is what happens in investing. A couple more slides here. So we're looking here at best and worst countries, looking at the returns on New Zealand, Australian, and the big world share markets. And I haven't got my glasses on, but up here we've got Italy with the best return in 85, is that? Yeah, and Japan's the worst. Then look at New Zealand. That was in the 80s boom. Highest of any of the highs all the way through. And next year, lowest of just about, I think there might be one worse one somewhere down there, isn't there? Yeah, down here, yeah, India. Global financial crisis, yeah. So you can see just about every country appears in the best list sometimes and the worst list other times, and so that's a really good reason not to just concentrate on New Zealand or any other particular country. You want to be in, and by the way, not Australia. Quite a few New Zealanders say, oh look, I've gone offshore, I've gone and invested in Australia, and that's better than being in only New Zealand, but it's not a whole lot better because the market that moves most closely with the New Zealand share market is the Aussie one. If you look at graphs over the years, it's far better to get into a big international fund that invests in countries all around the world. Okay, why have I got some countries in bold? These are the ones that went from being best one year to worst the next, or the other way around. So India went from best to worst. China went, down here we've got the Great Australia-China swapsies going on. And so all of those countries went from being the best of all the countries one year to the worst, or the other way around. So, you know, when investors say, oh, I'm going to go into Canada because they're doing really well lately, They did badly, then they did really well, and then they did really badly again. And that kind of thing just happens a lot in investing, so don't take notice of past performance. Was that a question up there? Oh, just scratching. It's like in an auction, you've got to be careful. You just bought the house. Oh, looking at KiwiSaver, so this is just very recent report just come in of returns for the year ending September the 30th. There were 5 default funds with 10-year information there. There are other default funds that have started since then, but I like to look at the ones with at least 10 years isn't long enough, but it's all we're going to get in KiwiSaver at this stage. Out of the 5 funds, the best one in the single year ending September the 30th was actually the worst of the 5 over 10 years, and the opposite. The one that did worst in the recent year was the best over 10 years. So if people are looking at what did well lately and thinking, I'm going to get into that, that's really not a smart idea. Far better to look at 10-year returns. Even then, there's a lot of research that shows, I saw a neat thing in America where they looked at the funds that had done best over a decade and how they did in the following decade. And the average one came about 3/4 of the way down in the following decade. And none of them did well in the following decade. So even decade-long information is not necessarily reliable. It's not a good idea to look at what's done well lately. Looking at aggressive funds, so those are the riskiest KiwiSaver funds. They're the ones that are invested just about fully in shares. Sometimes they've got a bit of commercial property, sometimes a little bit of other investments, but largely shares. So you've found a very similar pattern. There were 4 of them with 10-year data. The best in the recent year was 3rd out of 4 over 10 years, and the worst over the recent year was best over 10 years. Now, it's not always like that. If you look through the data, there are some funds that keep doing well for quite a few years in a row, and they might have done the best in the last recent year and also best over 10 years. I'm not saying that doesn't ever happen, because it sometimes does. But if you see that and think, whoa, I'm going to go with that one, it could very well be doing very badly in the next period. Why do you think that could happen with share funds? There's a particular reason why a share fund that does particularly well is more than averagely likely to do particularly badly next time around. Can you think why that might be? Yeah. Yeah. Yes. Oh, okay, yeah. They're stock pickers, they're risky. They're the riskier ones, so they're the ones that are going to do well and badly. In my book, actually, there's quite a big section on fees and KiwiSaver funds, and in one of the examples, people end up, I used the real fees that the KiwiSaver funds charged. In the highest fee one, they ended up with more than $200,000 less than in the lowest fee one. That was over a 40-year period. That was over a long time. But fees really do matter a lot. Ignore the ones that do well in the upturns and ignore the ones that do well in the downturns. Go for the low fees. I mean, honestly, because that's what the sort of point I'm trying to make here. The ones that have done well can just as easily do badly. They won't agree with me. The fund managers, the active fund managers who charge the higher fees say, no, we're good at picking the right shares, and they are until they aren't. I mean, there's a lot of luck in it, which is not acknowledged. And I've just been watching all these funds over all these years in America and then back in New Zealand, and I just go with the lowest fees ones. Warren Buffett, who probably everybody here knows about, one of the richest men in the world, who got there through investing shares in a big company called Berkshire Hathaway. I never attempt to make money on the stock market. I buy on the assumption they could close the market the next day and not reopen it for 10 years. He just buys and holds, and that's the secret we're talking about here. Don't try to time the markets, just buy and hold. Some research on forecasts. Somebody looked at 28 market timers over a long period, over 12 years, and therefore they had 4,500 forecasts. Only 10 of the 28. And all they did was accurately predict share returns for more than half the time. I mean, that's not exactly impressive. Morgan Stanley, and I put note, because Morgan Stanley, they're big financial services company, and they make money out of people trading. So their incentive is actually to say the opposite, to don't trade, but nonetheless they say None were able to predict accurately enough to outperform the market. As history has shown repeatedly, market timing is a losing game. It really is. There'll be people in this room who might yet be convinced of that, but please don't try and time markets. Work out when you should get out in and when you should get out again. It doesn't work. People who do that end up trading a lot. And here's just one sample of lots of research done on this. So this is over 20 years. Standard & Poor's 500, which is the biggest 500, basically the biggest 500 companies in America, they had a return of 7.7% a year, even though the global financial crisis came through towards the end of that period. The average share investor got 2.6. That was because they were trading, they were in and out. In an index fund where you just put the money in and left it there, you'd have 44,000. If you were the typical investor, you'd have 16,700. And this is the kind of data that happens all the time. There's over and over research showing this, that people who trade frequently don't end up doing as well. Why do they do worse? Can you think of why? The fees, absolutely. That's the main thing. Fees, commissions, brokerage, taxes. In New Zealand, if you're trading frequently, you should be paying tax on your capital gains, and many people are, and if you're not, I'd be nervous about it, especially the government's watching these things a lot more. And also just people just get stuff wrong so often. It's not a good idea. Fourth rule, never be forced to sell. Now this quote's cheating a bit here. Made my money the old-fashioned way. I was very nice to a wealthy relative right before he died. It's not really quite relevant to I couldn't find a good quote, and I liked that quote, so I thought I'll put it on anyway. Why you might have to be forced to sell is because you can't cope with the downturn psychologically, and there are some people, notably women, although certainly not always, but a lot of research shows that they tend to be the ones that get more nervous, or you get into financial difficulties that have nothing to do with the markets, but you've got to sell. So it's a really good idea to do a worst case scenario before you make the investment. So any of you who are investing in shares, think through what would happen. If your investment halved because of what's happened in the markets, because that could happen. It has happened historically, and it could happen again. And so you need to really picture how you would feel if you've currently got $10,000 in Sharesies and you find it's worth $5 after a while. Is that going to make you feel sick, and is it going to make you at that point get your money out and move it to something lower risk? Because if it is, that's the biggest way to lose a lot of money is selling when the markets are at the bottom. So you've really got to think that one through. And you've also got to look at what possible financial trouble. I mean, could you cope if you lost your job, or suddenly found that you had a leaky home, or or your business went belly up, or whatever? It's really important to think these things through and see how you could cope with it. Riskier investments, you've got to know you can stay in. So this is all right, wow there, because that's really long-term research. That's from before the 1929 share market crash, which was the biggest ever, I'm pretty sure. So over a very long period, they looked at the worst return over single years was minus 43, and the best was 54. Wide range. But over 20-year periods, within that long period, the worst 20-year period return, that's 3% a year, average annual return, and the best is 18. So you're not getting the highs that you do over the short periods, but you're certainly not getting those horrible negative returns. So you really want to be able to put your money, if you're putting it into shares, knowing that you can put it in there and leave it there for at least 10 years, and preferably longer, regardless of what happens to the markets or your personal circumstances. This is another way to look at the same concept. But so these are on international shares, annual returns ranging from plus 80 to down to minus 40, huge wide range. But that bar there is average 5-year returns for the 5 years leading to that. You can see over 5-year returns, you don't get 80s, but you don't get minus 40s either. And going down here, by the time you get to 15-year periods, you're not getting any negatives. You're getting a much smoother ride. So if you've got your money in for the long haul, you're not going to have terrible things happen to you. Finally, the last one and the nicest one. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas, said Samuelson. I just want to finish with two stories, two contrasting stories about sitting back and relaxing and letting your shares go and do their work without you worrying about it. Grace Groner died at 100 in Chicago. She bought clothes in rummage sales, walked rather than bought a car, one-bedroom house with 1960s TV, and her estate was $7 million. People were astonished. They couldn't believe where she got the money from. In 1935, she bought three $60 shares in Abbott's, which is a healthcare, Abbott Laboratories healthcare company, reinvested the dividends and just left them there. And so she was able to leave this wonderful legacy to the local college. Meanwhile, a KiwiSaver provider told me about this man. He complained because his return was -5. And when the provider went back and looked at it, each month, it was a good year. It was a good year in ending March 2017. Each morning he moved to the best performing fund in the previous month. So within the KiwiSaver scheme, he'd moved his money from high risk to low risk to whichever had done best. And if he'd stayed in his original fund, he would have had 9.2. And that, that's the kind of stuff that really does happen out there. So it's really nice message to know that you can just relax and you'll do rather well. Set up your investments properly so that you've got the right risk level for you in terms of your comfort and in terms of how soon you're likely to be spending the money. Drip feed in is a great way to do it. I know with Sharesies you can do that, can't you? And with KiwiSaver you're doing that, putting the same amount of money in every week or every month or whatever, regardless of what's happening to the markets. It works really well. When the markets go down, you end up buying more units. It's a terrific way to grow your wealth, and it's worry-free. You don't even have to think about it. You don't need to know whether the markets are up or down. You just drip feed your money. Check every few years. I'm not saying don't ever look at it, to just make sure you've got, well, for one thing, you've got money that you're planning to spend within 10 years out of shares and into something lower risk, because you don't want to find right when you're spending that money that it's just gone through a downturn. In my book, I say that laziness is good. It's the only really sort of field of human endeavour I can think of where doing less is better. But it really is better in investing, which is quite nice. So just going through the 5 rules again: spread your risk, largely ignore past performance, don't try and time markets, don't ever get yourself into a position where you're forced to sell, because that's when bad stuff happens, and sit back and relax.